So, what exactly is an inside bar? It is a very simple but powerful candlestick pattern. Imagine you have a big candle on your chart. We call this the mother bar. The next candle that forms is smaller. It is completely contained within the high and low of the mother bar. This smaller candle is the inside bar. Think of it like a baby kangaroo in its mother's pouch. The entire price range of the second candle, from its highest point to its lowest point, is inside the range of the previous candle. This simple formation tells you a lot about the market's current state. It signals a pause, a moment of indecision, before the next big move. The key feature of an inside bar is consolidation. The market is taking a breath. After a strong move up or down, price action tends to slow down. Buyers and sellers are in a temporary balance. Neither side is strong enough to push the price beyond the previous candle's range. This compression of price is like coiling a spring. The energy builds up. Sooner or later, this energy will be released, and the price will break out. This breakout is often powerful and fast. Understanding this concept is the first step to mastering this pattern. It's not just a small candle. It's a sign of potential energy waiting to be unleashed. Why is this pattern so important for traders? Because it offers a low-risk way to enter the market. The inside bar itself represents a period of low volatility. This means you can set a tight stop loss, which limits your potential downside. When the price breaks out of the mother bar's range, it signals that the consolidation is over. A new directional move is likely starting. This gives you a clear signal to enter a trade. The pattern is most powerful when it appears in a strong trending market. It acts as a continuation signal, allowing you to join an existing trend with confidence. The beauty of the inside bar lies in its versatility. It is not just for trending markets. You can also find this pattern at key market levels. For example, it can form near a strong support or resistance level. When an inside bar appears at a major resistance level after a long uptrend, it could signal a potential reversal. The market is pausing and might be getting ready to move down. Similarly, at a strong support level, it could indicate that the downtrend is losing steam. This makes the inside bar a flexible tool that you can adapt to different market conditions and trading strategies. The first step to trading the inside bar is to identify the market context. This pattern works best in two specific scenarios. The first is a trending market. Look for a clear uptrend, a series of higher highs and higher lows, or a clear downtrend with lower lows and lower highs. In an uptrend, an inside bar suggests a brief pause before the price continues to climb higher. It's a continuation pattern. The second scenario is at key horizontal levels. These are significant support and resistance areas on your chart where the price has reversed multiple times in the past. An inside bar at these levels can signal a major turning point in the market. Once you know the market context, you need to spot the setup. An inside bar setup consists of two candles. The first is the mother bar, which is typically a large candle. The second is the inside bar, which must have a high that is lower than the mother bar's high, and a low that is higher than the mother bar's low. It is very important that the inside bar is fully engulfed by the previous candle. Some traders are strict and say even the wicks must be contained. I suggest you follow this rule, especially as a beginner. This ensures you are trading a true period of price contraction. Setting up the trade involves marking the key levels of the mother bar. Use your charting tool to draw a horizontal line at the high of the mother bar and another line at the low. These two lines create a small trading range. This is your breakout zone. The price is currently trapped between these two levels. Your trading plan will be based on the price breaking out of this zone. A break above the mother bar's high is a bullish signal. A break below the mother bar's low is a bearish signal. This simple preparation makes your decision-making process clear and mechanical. Let's look at a bullish example to make this clearer. Imagine the market is in a strong uptrend. You see a large green candle form, followed by a smaller inside bar. This is a potential continuation setup. You would draw a line at the high of the large green mother bar. This line is your entry trigger. You will wait for the price to break and close above this level. This breakout confirms that the buyers have returned and are ready to push the price higher, continuing the original uptrend. Your plan is now in place, and you are simply waiting for the market to confirm your analysis. There are two main entry strategies for trading the inside bar. The most common is the breakout entry. For a bullish setup, you would place a buy stop order just a few pips above the high of the mother bar. When the price breaks this level, your order is automatically triggered and you enter the trade. For a bearish setup, you would place a sell stop order just below the low of the mother bar. This method gets you into the trade as the momentum kicks in. It is a proactive approach that aims to capture the start of the new move as it happens. The second method is the false breakout entry, which is a more advanced contrarian strategy. Sometimes the price will initially break out in one direction, only to quickly reverse and break out in the opposite direction. This is a false breakout. For example, in an uptrend, the price might briefly dip below the mother bar's low, trapping bearish traders. Then it reverses sharply and breaks above the mother bar's high. You could enter on this reversal, betting against the initial failed move. This strategy can be very profitable because it catches traders who are on the wrong side of the market. Setting your stop loss is crucial for risk management. The location is quite intuitive with the inside bar pattern. For a long or buy trade, you can place your stop loss just below the low of the mother bar, or for a tighter stop, you can place it below the low of the inside bar itself. For a short or sell trade, your stop loss would go just above the high of the mother bar. The small size of the pattern often allows for a relatively small stop loss, which means you can have a very good risk-to-reward ratio on your trades. Always define your exit point before you enter the trade. Finally, you need a plan for taking profits. A simple approach is to use a fixed risk-to-reward ratio. For example, you might aim for a profit that is twice the amount you are risking, a 1-to-2 risk-to-reward ratio. If your stop loss is 50 pips away, you would set your take profit target 100 pips from your entry. Another method is to trail your stop loss. As the price moves in your favor, you can move your stop loss up to lock in profits. You could also identify the next key resistance level on the chart and set your take profit target just below it. To improve your trading, you must know when to avoid the inside bar pattern. This pattern is not effective in low volatility, choppy markets. If you see many small overlapping candles with no clear direction, it's a sign of a range-bound market. An inside bar in this environment is meaningless because there is no stored energy to be released. The price is likely to just drift sideways, so always look for the pattern within a clean and obvious market structure, like a strong trend or after a significant price swing. Avoid trading it when the chart looks messy and directionless. Using confirmation indicators can greatly increase your winning rate. Don't rely on the pattern alone. You can combine it with other tools to confirm the signal. For example, you can use a moving average like the 20-period exponential moving average. In an uptrend, you would only take long inside bar trades that form above the 20 EMA. This ensures you are trading in the direction of the short-term momentum. You could also use an oscillator like the RSI to check for overbought or oversold conditions, especially when trading reversals at key levels. Another powerful technique is to combine the inside bar pattern with other price action signals. For example, if an inside bar forms at a key support level and is also part of a bullish engulfing pattern, the signal becomes much stronger. You are getting multiple confirmations from the price itself. You can also use trend leads. In an uptrend, if an inside bar forms right after the price bounces off a long-term ascending trend line, it is a very high probability setup. The more reasons you have to enter a trade, the better your chances of success. My practical advice for beginners is to start with patience and discipline. Do not rush to trade every inside bar you see. Open your charts and go back in time. Manually scan for the pattern and see how it performed in different market conditions. This backtesting will build your confidence and help you develop a feel for high-probability setups. Start on a demo account and practice executing your trades according to your plan. Focus on one strategy, master it, and remember that consistent profitability comes from disciplined execution, not from finding a so-called holy grail pattern. The inside bar is a tool, and its effectiveness depends on the skill of the trader using it.